Hello friends, this is Raj Sastry from Raj Option Trading. Today is April 30th, 2021. I want to talk about few earnings play. This week is full of earnings and we'll cover few stocks which have dropped substantially and see if they're good to invest right now. With that, here are a couple images. One is Twitter earnings was this week and stock dropped. And then we got Ribbon Communications. Again, same story. Stock dropped a lot. And the last but not least is IIVI. These guys are into scientific instruments, and this stock also dropped a lot. So with that, let's jump in and see what we can buy due to this sell-off. So with that, let's jump in here. As you can see here, I got a list of 20 companies here, and it's organized by the stock which has dropped the most in 1 week. So in this case, Cara Therapeutics dropped 50% in 1 week, and from there on, it's ascending order. We got less and less drops. So with that, typically what I like to see in these companies is I like to see good sales growth, and I like to see good gross margin. In case of Cara Therapeutics, I think there is a good sales growth. It's actually huge sales growth. If you see quarter over quarter, it's huge number here. Um, but if you see here 1 week drop, it's 50% drop in 1 week. And in 1 day, there is a 7.96% drop. So typically what I would do in these situations is, there is a good sales growth, there is no gross margin, stock has dropped a lot, and stock is down 18% for 1 year. So normally in this scenario, I would buy a little bit. It's a $12 or $13 stock. I would buy a little bit, maybe say 50 or so, just to track and see how it's doing. Normally you get a bounce in these scenarios, and you could if you want to keep it, you can keep it, or you can trade it if you want to. But normally that's a good way to play these therapeutic stocks because they bounce a lot. If they start doing really well, you could you could hold a little bit, and then you can sell a little bit. So then we got Bright Cove. Bright Cove, as you can see here, again $14 stock. I like this stock because it's got nice sales, 197 million, and good sales growth. It's 1 year 4.30%, quarter over quarter 12.80%. That's a good sales growth, nice gross margin, and institutions are supporting this company. 88% institution ownership. That's really nice. And 1 week they've dropped 25% and 6% in 1 day. Even after this drop, stock is up 64% for 1 year. So I think that's a good one. I think we should probably look at buying this stock. Very cheap stock. It's $14, and even from a price to sales perspective, from a valuation perspective, it's pretty cheap. So with that, I would buy Bright Cove into this sell-off. Next, we got a couple more here. I also like to, the NeoPhotonics. Even though sales growth is not there, it's got good 33% growth in 1 year. So this is a speculative play. I would not buy too much because there is no sales growth. Next one is Greenhill. So Greenhill, as you can see here, it's a $15 stock here, and nice sales. We got 312 million sales, and quarter over quarter sales is great. It's 31.90, and nice gross margin, and there is institution support for this stock also. It has dropped 18% in 1 week. In 1 day, it has dropped. Today it has dropped 15%. So even with this drop, it's up 37% for 1 year. I think it's a good one. I think it's got a lot of things going on for this. So I would buy Greenhill. Next is American Well. This used to be one of those good companies into telemedicine, and everybody thought this company is going to give their run for teledoc. But company has really did not do great. It's down 43% for 1 year. So this is again a contrarian play. few folks I know, they really love this company. You could buy a little bit if you want, but because there is no sales growth, I would be a little careful, but I think it's beaten down so much, it may be okay to buy some. Next is Twitter, Jack Dorsey's company. This company is doing great. $55 company and nice sales growth. I like this, quarter over quarter, 28% sales growth, good gross margin, and nice institution support. Stock has dropped 17% for the 17% for the week, 15% for one day. So with Twitter, I've been watching this stock for a long time, and this stock normally, comes down pretty hard in some earnings. That's always a good buying opportunity. So with that, I would buy Twitter into this sell-off. It will bounce nicely. Twitter is a great company under Jack Dorsey's leadership. Next is let's look at Ribbon Communications here. So Ribbon has done nicely, as you can see here, 1 year 92%. That's a great performance, and I like this sales growth 51% for quarter over quarter, 40% for 1 year, and nice gross margin and good institution support. So with that, I would buy Ribbon Communications into this weakness. And next is Cyrus Logic. Cyrus Logic is a great company. It's an Apple supplier, as many of you know. It's into chips. And as you can see here, sales growth for 1 year is 5%, which is good. Quarter over quarter, 29% sales growth. That's also good. Nice gross margin and very good institution support. Stock has dropped 14% for the week, 13% in one day. So, it's down 4% for the year. So with that, this company is really tethered to the iPhone growth to some extent. I would buy this into this weakness. I've seen this company, going so wild up and down, during the years. So I think this is a good company. I would buy some on this weakness and take it from there. Next is one of my favorites, IIVI. This is also into scientific instruments, and company has got a very good sales growth, 44% for 1 year, 18% quarter over quarter, good gross margin, nice institution support as you can see here, and a little bit high float short ratio here, just like your Microvision, same story. So I would buy this stock. It's down 13% for the week, 6% for one day, nice 89% growth for performance for 1 year. Then we got a couple more here. MiMedx. I think this one is there is no sales growth here, but it has done nicely for the year, 155%. In these type of scenarios, when there is no sales growth, company has done nicely. There is a huge drop. I would typically buy a little bit and keep it, so that way just see how it does. Then we got three companies here: Casa Systems, DouYu, Pitney Bowes. All same story, nice sales growth as you can see here, good gross margin. They've dropped so much, 13% for the week, and dropped nicely for the day also. And they got good 1 year growth. I would buy these also into weakness. So with that, I did not cover few stocks. I'll quickly touch on those. One is Microvision. Microvision is it's a aggressive type stock. I think it gets manipulated often with this high short ratio and high valuation. The way I play this is really, if it dropped so much, last couple of days this has dropped, I would buy a little bit, and there are wild days for this. It will go up crazy. Then I would sell some. So that's a good strategy for Microvision, which trades very, very rapidly. So I think it's good to buy on a down day, or after a couple of down days, and then sell a little bit later. So with that, let's go into next slide here. We got a couple more here. I think Wisky also same story here. These guys are also trading very wildly. And as you can see here, high short interest. I would do same thing with this stock also. If it dropped so much drastically for a couple of days, I would buy some and sell it off onto a bounce. Then we got three stocks here: Sunrun, Alpha Pro, and Sonoma Energy. And all these companies, as you can see, are nice sales growth, which is good, and they've dropped so much for the week, and they've dropped for the day also. And in this Sunrun, it's done nicely for the year, and same is the story with the Sonova. So I would probably buy these stocks on their weakness here and take it from there. Next we got Spotify. Spotify is a great company. Kids I know, they always love this company. They got nice song selection, and you can do your own playlists. It's kind of it's got a lot of artificial intelligence into the playlists. With that, I think it's a nice sales growth. As you can see here, stock has been dropping a little bit, like all the way to 6 months. As you can see here, 5% for 6 months, 3 months, 22%. I would buy this company onto the weakness. This company is one of those, good companies. Drops significantly at times, but it's a good buying opportunity. Then we got a couple more here, as you can see. LG Display has done nicely for 1 year. I think this could be a good stock. The reason I did not highlight is sales growth little bit less, but I think it's okay. This is a good one to buy on the weakness. It's just $10 stock, so not a high price stock at all. Then we got a couple more here: AXTI, ACRS, Eldorado. And I think, as you can see here, very nice sales growth and nice gross margin, and they've done nicely for 1 year, with the exception of Eldorado. You could buy some on the weakness and take it from there. Eldorado, as you can see here, it's been dropping all the way: 6 month, 3 month, 1 month, 2 weeks. I mean, if you want to avoid this, it's okay too. But other two, they are doing nicely for the year and good sales growth. Eldorado could be good to buy some, and don't invest too much. See if it can bounce back. Then we got two more here: AAOI, Applied Optio, and ResMed. And ResMed has dropped significantly today. Earning miss. It's a great company. So is Applied Optio. So they've done nicely for the from a sales growth perspective, as you can see here, and good from a gross margin perspective. ResMed has got great gross margin here, and as you can see here, Applied Optio is down for the year, and ResMed is up 21% for the year. So ResMed is a great company. I would buy this on this weakness, and it will give you a good bounce back. So next we got a couple more here: Sony, TPI Composites, and Dana. With the exception of Dana here, which is a little bit negative for 1 year. All other companies are doing good for 1 year sales growth and quarter-over-quarter sales growth, and nice gross margin for at least Sony here, and they've done nicely for the year, as you can see here. It's a good 1 year performance here. I would buy this also on the weakness and take it from there. Then we got On Semi, Endeavor, Silver, Etsy. Nice sales growth, as you can see here, with the exception of On Semi. For 1 year it's negative, and nice performance for 1 year. It's a nice sales performance, and I would buy this on the weakness here. And then we got a couple more here: MGNX, Dexcom, one of the favorites into glucose monitoring. Nice sales growth, good gross margin for Dexcom, and 1 year performance is great. I would buy some on this weakness and take it from there. Next three are CPS, Canon, and Anaplan. Sorry, APN. APN is into all the business process automation. They also have low code, no code type environment. This company has done tremendously well. I think last year, now stock has dropped significantly. Could be good to buy. Canon is into Bitcoin mining machines. I think this is also a good stock to buy on any weakness. It's one of those crazily crazy stocks goes up and down wildly. If you're buying it, make sure it's there are a couple down days, then you can buy. And when Bitcoin recover, this will also rebound nicely. So with that, let's look at a couple stocks in a little more detail. First one is Brightcove. As you can see from the chart here, stock has done very nicely. This is a 1 year chart. There's the earnings, stock bounced, earnings, stock kind of bounced a little bit, earnings, stock bounced. Now earnings, stock dropped. So I think this stock historically has done nicely, as you can see here. Now it kind of fell off of the Bollinger Band below the lower band. So if you look at the earnings per share, it's improving. Right now it's a negative 15, which is good. I think at least there is a positive trajectory here. It's getting better. And sales, I love this sales also. It's been in a good clip here. It's increasing, which is always a good story. Shares outstanding is gradually increasing, not too much. It's nothing to worry about here. And this provides cloud-based services for video, and they also help customer to publish, distribute video to internet connected devices. So with that, I think they surpassed the earnings and revenue estimates, but investors weren't happy about company's second quarter outlook. That's why stock dropped. And when the stock drops like this, there's no point in looking at the chart at the time. Chart will always look ugly when there is a huge drop. So I would kind of discount. I would kind of look at the historic way the stock has traded. What has happened in the past when stock dropped. It recovered. So I think this is something similar. I would think this will recover also. And we talked about the fundamentals. I love sales growth. I like the gross margin and institution support. The stock has dropped a lot, up for the year. And from a fundamental perspective, nice margin. I mean, margin is okay, not too great, but still losing money from a net margin perspective. Earnings per share is negative, meaning there is no earnings. And they got a lot of stocks available, around 40 million or so. And nice cash. I think debt is low, which is good. And I think from a volume perspective, I think they're around 385 for average 3-month volume. But today they have increased the volume significantly because of this drop here. Insiders are selling a little bit, which is not to be alarmed. And they got institutions buying the share. IV percentile is low, which is normally happens after the earnings. We call it IV crush because after the earnings, all the implicit volatility has dropped. That's why there's IV crush. So with that, if you're a option trader, you're okay to buy some option. Right now, stock is around $14. You could buy maybe $10 option or maybe $8 option around delta 70 or so or higher. It's okay because implied vol is low at this point. Put call ratio is very low, meaning there are a lot of people in the options market betting the stock will go up. And earnings just happened. Next earnings is coming later. I think it's a good time to buy some stock itself because it's a low price stock, $14, and take it from there. Next one is Greenhill. Greenhill, as you can see, a very nice stock chart here. It's been doing nicely. Earnings here, stock went up, or a little bit up. Earnings, stock kind of came down, then went up. One more earning, stock went up. One more earning, stock came down. It's below the Bollinger Band right now. And as you can see here, from a earnings per share perspective, the company is making money, and sales is pretty good. Shares outstanding is reducing. I love this shares outstanding decreasing, over the years. That's a good story. And these guys are an independent investment bank and provides financial and strategic advisory services. So with that, company are done nicely. It's a $15 stock. They got good sales growth here, quarter over quarter, good gross margin, and nice institution ownership here. And 1 week drop is so huge. 1 day drop is also huge. but have done nicely for the year, 37%. And from a fundamental perspective, again, companies making money. Earnings per share is $11.02. Sorry, $1.65. And shares outstanding is pretty good, not too bad at all. They've been decreasing it, as you can see here. And they got debt is a little high. I think for financial companies, probably it's okay. And as you can see here, insiders are selling the stock, which is okay. And institutions are also selling it lightly. IV percentile is low. Even if you want to buy a call option, delta 70 or higher, 3 months out, you could do that. Put call ratio is very, very, very low. That means there are more people buying call options than put, which is good because that shows there's a conviction among option market around the stock to go higher. So I think overall it's good. They did nicely. I think the issue was earnings and revenue lags the estimate. That's why stock dropped, which happens. Normally, some these type of companies sometimes they can't always deliver. I think they had some little bit lag here. I would buy this company on the weakness. So next one is Twitter. Everybody knows Twitter. Everybody loves Twitter. Stock has done nicely. Now it kind of traded sideways. We call it a volatility tunnel. Then finally dropped out of this volatility tunnel to the downside. I mean, if you look at the RSI, you could kind of make out it's kind of going down, down, down. Just dropped. And I think from an earnings per share perspective, companies spent a lot of money on their own product and people because of the COVID. That's why earnings per share dropped here. Nice sales. Top line is growing. That's a good story. And shares outstanding is pretty stable. Nothing to alarm. And everybody knows Twitter. They provide platform for self-expression, and people can put some tweets. They also got some advertisement revenue. So with that nice sales growth, I love this. 28% quarter over quarter, 6% in 1 year. Good gross margin and nice institution ownership. Stock dropped 17% for the week, 15% for the day. And they're still up, for the year, 77%, which is a good story. And as you can see, earnings per share is negative. They got some debt, which is manageable. They got more cash than debt, and institutions are selling lightly. Insiders are also selling, which happens. Nothing to alarm here. IV percentile is very, very, very low. This is called IV crush just after the earnings. Even if you want to buy a call option, delta 70 or higher, 3 months out, you could easily do it. You will not be paying too much here. Put call ratio is low, meaning there are people betting in the options market. The stock will go up. So with that, I would buy Twitter on this weakness and hold it for a long time. So last but not least is Ribbon Communications, ticker symbol RBBN. As you can see here from the stock chart, stock has done nicely over 1 year. I think now stock has been dropping. After the earnings, it dropped again. So I think if you look at the pattern here, earnings stock traded sideways to low, earnings stock shot up, earning stock came down crashing. Now earnings stock came down crashing. So there's a good chance this can consolidate and make its way higher, mainly because by looking at these numbers here, they have turned earnings per share positive here, and and their sales is pretty in a good clip here. They're improving their sales. Only a little bit alarming thing is the shares outstanding is a little bit growing a little more. So I would watch earnings per share, but I think it's not a huge alarm. It's manageable, but it's growing a little bit. So with that, these guys are into communication technology. They're into cloud and edge, IP and optical networks. I think overall it's a technology play here, something like a software and hardware products. and these guys have beat earnings and revenue estimates, but a little bit light on the guidance. That's why stock dropped here. And from a performance perspective, I think they got nice sales growth here. I like the sales growth. 1 year 40%, quarter over quarter 51%. Stock has dropped 16% for the week, 5% for the day, and they've done nicely for 1 year. I would take advantage of this weakness and buy some. And they have net margin, they have earnings per share, which is positive. The company is making money at this point. They got good cash, and debt is a little high, but I think it's manageable. And as you can see here, institutions are buying the share lightly. IV percentile is low, and put call ratio is high. This means there are a lot of people betting the stock will even go further down. Sometimes this could be a contrary indication, so you could take advantage of this, and you could buy the stock at the lower price. And because a lot of people bought put option, if the stocks goes higher, all these put options they bought will expire worthless. So with that, that's a wrap. Thank you very much. There are a lot of companies. I will share some of the companies tomorrow also. With that, happy investing. Thank you.